everybody, welcome back to the Bitcoin layer. Today's video is about why I think this period of tightening financial conditions and risk off that we've experienced is finally coming to an end. So let's look at the timeline of when we entered this period of tightening and why I believe that it's finally ending now. So let's look first at CPI, which is the inflation metric in the United States, the year-over-year change. So this is a table of CPI, and I want to point your attention to May 2021. This is when inflation finally peaked above 5% for the first time in decades in the United States. And for the first time in this cycle, inflation above 5% really started to get people thinking that the Fed would have to potentially start tightening. But I want to then look forward a few months to October of 2021. This is when inflation got to 6%. Now, it did get to 7% in December of 2021, but this period of October to December really set the groundwork for an immense tightening of monetary policy. So the Fed didn't actually raise rates until March of 2022, but the interest rate market started to price in a tightening long before the Fed actually got going on monetary policy. So now let's point your attention to this graph of 10-year yields and where they went after this period of October to December of 2021, when inflation went from 5 to 6 to 7% only in a few months. Now, look at the first blue arrow pointing upwards. This is the first week of 2022. So basically what's happened is the inflation numbers that are going from 6 to 7% have started to come out, and you see Treasury yields really start to move. Now, I've put in as well this trend line of resistance around 1.5% to show you that yields were consolidating in this area below 1.5% for months. And yields didn't start to move due to inflation really until inflation got above 6%. Now, what happened after yields broke above 1.5%? And this is the 10-year yield we're talking about here. They went all the way to 3.5% really quickly. So this is from January until June. So a period of 6 months, a half a year of yields going absolutely in one direction in a very, very strong way. Now, let's look at the chart of stocks over the same period. Okay, so you guys see this blue arrow pointing downward? What I've done here is I've put the arrow at the same point in time that yields peaked above 1.5% and unleashed this cycle of tightening from the interest rate market. So let's talk about the difference really quickly between tightening from the interest rate market and tightening from the Fed. So people usually think of tightening monetary policy as the Fed raising rates and making it more restrictive to borrow and basically tightening financial conditions by moving the policy rate up. But the rates market is what leads the Fed. I wrote a piece a few months ago called "The Fed is a Slave to Rates Traders." It's because the rates market always prices in moves in monetary policy long before the Fed even gets to them. So what we had was a 200 basis point financial tightening by yields going up over that same period, even though the Fed had only tightened by 100 basis points during that time. And again, yields started to move higher in January in a material way, but the Fed didn't even get to its first 25 basis point hike until March. So the rates market is what does the tightening long before the Fed actually tightens monetary policy. Now, back to this chart of the stock market during the same period of when we were looking at Treasury yields. This drawdown in stocks from the same exact point that Treasury yields went above 1.5%, down to the point where we reached in June. This drawdown in stocks is not a coincidence when looking at the move upward in treasury yields. Why? Because tightening financial conditions are negative for risk assets, and the exact opposite is also true. So when financial conditions start to ease, that means that risk assets will finally find a bid. Okay, so does that mean that the Fed is done hiking rates? No, it's actually not the case. The Fed is still committed to hiking rates another at least 75 and potentially 150 basis points over the next 3 months. So the Fed will hike interest rates again at the end of July, but it's not the Fed's monetary policy decisions that we are watching most closely. We are watching the rates market. So now let's go back to the chart of 10-year yields. So we can see now the arrow pointing down. This is the price action from June, and we can see that yields touched 3.5% on the 10-year, but have actually come down and settled below 3%. I believe that this spike to 3.5% that we saw a few weeks ago was the high point on treasury yields for this cycle. And as yields start to come back down, that is the rates market telling the Fed that it is running out of room to hike rates, and that when yields go back down below the Federal Reserve's policy rate, that is the rates market saying, hey, Federal Reserve, you are done hiking and you actually have to start cutting now. So that process has, I believe, started. Now, there's still quite a big difference in the policy rate today and where treasury yields are, both on the 2-year part of the curve and the 10-year part of the curve. But I do believe that the Federal Reserve policy rate will go up to a point where treasury yields cross below. And at that point, the Fed will have to stop hiking and eventually start cutting rates. I believe risk assets already know this. Now let's look at where treasury yields topped at 3.5% and line that up with the stock market. Now, looking at the stock market, we can line up the point that yields got to 3.5% with this local low in the stock market. So this is the S&P 500 finding a local low in the 3,600 range. So it is my belief that when yields top, the stock market reacts positively, and we know that Bitcoin and the stock market have had a very strong correlation all year, and really looking back the last several years, for most of the time, Bitcoin and stocks are correlated. So I do believe that the risk on period has begun, not because the Fed is stopping their hiking policy, but because the rates market already forecasts the end of the Fed's hiking policy. So for these reasons, I believe that the narratives have finally started to shift from tightening to easing. It's coming from the rates market, not the Fed. And as we shift into an environment of lower interest rates due to lowering inflation expectations, we should see risk assets start to perform better and start to end this bleeding period in which they're only responding to higher and higher rates. Now, even though inflation is at 9% today, which is still another cycle high for the period, inflation expectations in the forward market are starting to come down as the effects of tighter monetary policy and really higher interest rates are filtering through to the rest of the economy. Remember, the Fed starts hiking long after the rates market starts pricing in tightening. So mortgage rates started to rise long before the Fed even started to hike. This effect of higher rates throughout the economy will decrease borrowing, decrease spending, slow the economy down, and slowing inflation will lower interest rates. Lower interest rates will finally start to support risk assets. Also remember that risk assets generally bottom about 4 months before a recession is over. So if we are already in a recession and the bottom in risk assets was in June, that might mean that the end of the recession is in October, meaning a recession from January to October. So I don't know exactly when the recession started, when it's going to end, but my general thesis is that the recession in this country happened from January to sometime, it will end sometime in the fourth quarter of this year, that risk assets have bottomed already because rates have already topped. Thanks for sticking with me for this explanation of why I believe that the risk off period is finally ending. I want to thank my sponsors, Zebedee and Voltage. I'm really excited about partnering with Zebedee. They are building what I believe is a really important user experience for people that are onboarding to the Lightning Network. Now, Zebedee is a company focused on the gaming industry, so how does that fit in with global macro? Well, you guys know how much I believe in the Lightning Network, and I believe that what Zebedee is doing is it's introducing the Lightning Network to people in a way that makes them understand why instantly transacting Bitcoin is so important. So check out our Lightning address, the Bitcoin layer at zebedee.gg. Go download their new wallet for a great first Lightning Network wallet and get your own Lightning Network address. I'm proud to have Voltage as the sponsor of my Substack. Voltage is powering businesses to be able to run their own nodes, both Bitcoin and Lightning Network. I'm really excited about working with Voltage because I believe they are powering some of the most important businesses in the Lightning Network ecosystem already. Go check them out.